Hey everyone, Mitulan Parapanayagam here from Foundation Capital Private Real Estate Trust. Today in this video we're going to talk about and go through CMHC's MLI Select program. So CMHC's MLI Select program is a program that basically offers a lot of flexibility to encourage the preservation and creation of affordable and accessible climate compatible units. And the flexibilities that it provides is that it provides a higher loan to value, longer amortization periods, lower debt service coverage ratios, and reduced premiums. So let's dig a little deeper at a glance. So for the property type, it predominantly looks at new and existing affordable, energy efficient, or accessible housing projects. So in the previous video, we talked about standard rental housing, predominantly for apartment units. As it relates to us, we buy buildings that are anywhere between 10 to 50 units. So for us, it would be if we were to go take our existing buildings, as we buy these buildings, look to add energy efficiency to them, make them more accessible, or provide certain units that are affordable. And we're going to go through the different criteria for it there. Typically, the project size for this is about 5 units. Except in retirement homes where the minimum is about 50 units. Again, similar to the standard program, the non-residential component cannot exceed 30% of the gross floor area or the lending value. So the loan relating to the non-residential component must not exceed 75% of the lending value of the non-residential component. So you're capped. So even if your residential side, it goes to 95% loan to value if you're buying a mixed use. Your commercial portion will get capped at 75. So your overall LTV will get lower in a mixed use. And again, you're noticing that in the MLI program, mixed use isn't as favorable. They do reduce like the financing because it's basically meant for residential rentals. One of the criteria here is that borrowers have to commit to any combination of the following social outcomes through a minimum of 50 points to qualify for MLI Select. So let's jump in and understand what that means. So there's obviously existing projects and new projects, and you need to hit a certain number of points through a combination of affordability, energy efficiency, and accessibility in order to really kind of maximize your overall borrowing power through this program. So what is the different percentage points and how does it make sense? So for affordability, they basically say that a certain percentage of the units have to be equal to or below subject market rent or the median renter income. So in new construction for level 1 where you get 50 points, 10% of the units have to be at a maximum of 30% of the median renter income. How do you find the median renter income? Well, you can go to the CMHC reports, CMHC rental market reports to find what the median renter income is. You can also Google it or talk to your mortgage advisor who will be able to provide you that. Level 2, you're looking at 15%, and then level 3, you're looking at 25%. So, for new build, doesn't seem too bad. It seems like, you could get your the maximum number of points very easily by making a portion affordable. But let's go take a look at some of the other factors as we go into assessing, why you would do this. So again, with affordability for new builds, you're going anywhere between 10 to 25% of the units have to be affordable. What about existing properties? And that's where predominantly we currently operate is we buy existing buildings and we renovate them. So why, and so do some of our other competitors. So would they use MLI Select and would they use affordability? And let's take a look. So for existing buildings, if you make it affordable, you have to make 40% at the maximum of 30% of median renter income to just get 50 points. But if we go back and we look at new construction, we see that when you make 25%, you get 100 points, almost double. And the requirement for a new construction is a lot lower. So clearly creating new supply of affordable housing units is more favorable versus just buying existing and keeping it at affordable. And that's because usually most buildings trading hands, people aren't turning over the units and that's our bread and butter. But as a result, CMHC is saying, hey, if you're buying existing and trying to turn it up, through the MLI program, they're not going to give you a lot of points unless you really keep a lot of the units at 30% renter income. So you see here, level 1 is 50 points is 40%, 70 points is 60%. Level 3 is minimum 80% of the units have to be a maximum of this. In my opinion, this is my personal opinion, and how I kind of like to underwrite deals. I never want rent or income to be capped. However, what you have to take a look at is to see what is the median renter income of that area and what are rents. Sometimes when you actually take a look at the market, obviously in higher populated areas like Toronto, GTA, Southwestern Ontario, like London, and Kitchener-Waterloo, you have such a variety of renters and such a large population. The median renter income is much higher, and it doesn't really make sense versus kind of the units and rentals that are available. But in some other tertiary markets, your median renter, 30% of median renter income might be in line with market. So you have to look at things by deal basis, and it can make sense to maybe do affordability. But for the majority, for the most part, we are not doing that at all. And so that really comes down to, so here in this case, the borrower has to commit under affordability for a minimum of 10 years from the date of first occupancy, and affordability commitments of 20 years or more will be awarded an additional 30 points. So clearly, some people might say, you know what, I'm going to go do level 1 and I'm going to do like 20 years so they can get, 80 points or more, or level 2 and get more points. And so they'll put the affordability component in for much longer. And, sometimes they leverage other government existing grants for that as well. Again, if you're trying to maximize your return, it doesn't always make sense to do the affordability route. But that doesn't mean that we are also looking at this program specifically not from a for-profit standpoint, but in a separate vehicle altogether. We're looking at it more for providing social benefits to the community and for investors who want to make less return, but for the social benefit of people in our society. So that's where we are looking at affordability and utilizing government grants. So then that brings us to energy efficiency. So this outcome is based on the improved performance over the baseline. So how does this kind of work? Well, there's a current standard in place for how you have to construct. And again, as long as it's beating the National Energy Consumption Board standards, or the new build construction standards, you will get these points under the new construction. How does this work for existing properties? Well, this is kind of shitty in my opinion, because there's times where you might buy a building outside of CMHC, you might turn it over, you might do a lot of these energy efficiency upgrades, but before you go to CMHC and you get this financing, you've already done this work. CMHC will not count that work being done unless it was done, I believe, depending on the energy provider, or like the energy efficiency report provider, if it happened within the last, I think, 12 to 18 months. So if you bought a building and it's been 3 years and you did the work already and 3 years have gone by and now you're trying to get some of those energy efficiency items counted towards it, they will not include it. So you will have to figure out new ways to increase past the baseline. So again, for existing properties, level 1 baseline means you have to increase by 15%. Level 2 is 35 points, is 25% decrease, and then you have to decrease by 40% for 50 points here, based on the baseline. So your baseline might actually be better already than the NECB and NBC standards. However, because you didn't do that beforehand, before you went into it, you will sometimes not be able to achieve 50 points. You'll only be able to achieve level 1 or level 2. And a big component of energy efficiency is you have to look at the cost approach, or the cost basis of how much it's going to cost you to do these renovations to make the building more energy efficient. And a lot of analysis that we do is like, okay, this building needs to achieve a certain number of energy efficiency. How much is it going to cost us to do these renovations? How many, we have to basically do this across every single unit in the building. So you're going to disrupt all those tenants. And then what can you actually achieve? So if it turns out that the money that you're able to take on in addition by going the MLI program versus the standard program equates to basically equal what your cost is to administer this program, you end up losing money on the time that it takes for you to administer this, to deal with all the tenant headaches and stuff like that. And you're probably better off just focusing on turning over units under the rental standard program and taking money out that way. So this covers energy efficiency. So that's like, what you will do is you go low flush toilets, you'll change window panes, you'll change heating systems to be like heat pumps so you can control it better by region and area, by unit in the building versus just heating the entire building at all times or cooling the entire building at all times. So there's different factors. So you'll have an energy efficiency consultant come in, they'll do an assessment of what your baseline performance is of your building. Then they'll model it out and they'll tell you if you can achieve level 1, 2, or 3. And then based on that, you'll choose like, from a cost efficiency standpoint, I can do these items to achieve this. Or you might say, fuck, it doesn't matter if I do all of this, it's going to still be really high. So you kind of got to decide if you want to go the energy efficiency route. And then you have accessibility, and so there's different requirements and different standards that they have in place through the Canadian Standards Association, where you have to design or redesign the units to be accessible and adaptable, and there's a variety of criteria here that you can follow, but you have to make sure you're working with your architect and you understand these standards accordingly. Sometimes accessibility can mean just as simple as removing bathtubs, making it into a roll-in disability accessible bathroom. However, certain things will apply where you need to be able to have two people in wheelchairs be able to go side by side in your hallways and stuff like that. So you might have to end up doing work in your hallways and other things. So you basically need to do a whole study and analysis. And so one of the things you're probably understanding as we're going through this is that there's a lot of pre-work you have to do before you decide if you're going to do MLI. And there's a lot of reports you have to pay for in advance that you might go through and determine, like, it doesn't really make sense for me to do the MLI program. I'm just going to go the regular standard program, just because in order for me to do it, the cost might be prohibitive. But, obviously for someone like us who does it all the time, it makes sense. But if you're a new person looking to do it, you won't really know what the standard costs are. And in another video, I will be covering kind of what some of the standard costs for things that we will do for us to make sense for us to do MLI. Otherwise, we will go the standard route for most of our financing, or even look at bank financing. So again, this is for level 1 is 15% of the units have to follow universal design, 15% of the units are considered accessible. Level 2 is 15% are considered accessible. 85% are universal design. It receives the Rick Hansen Foundation Accessibility Certification. Again, these are only 20 to 30 points. So again, you want to see if it's worthwhile. For the affordability criteria, it applies for the entire duration of the affordability period at the date of first occupancy for new construction or major renovation, and the interest adjustment date for existing buildings. Documentation is required to support ongoing compliance throughout the affordability period. So if you're doing this for 10 years or 20 years, you're going to have to do reporting to the lender, who's going to report to CMHC. And if they want to audit you and ask other questions, they will. So again, one thing people need to factor in is that yes, MLI might give you higher loan to values, but there's a lot of other work that goes into place that you need to determine what that value is and if it makes sense for you to proceed with this financing. Then it comes to energy efficiency and accessibility criteria. The work must be, so where improvements are undertaken prior to the request for loan insurance, documentation confirming achievement of the criteria is required as part of the loan insurance application. Work must have been completed within 12 months of the request. Where insured financing is used to undertake improvements or construction, documentation confirming achievement of the criteria is required within 60 days after the last advance. Where improvements are completed with the borrower's own resources or non-insured financing, documentation confirming achievement of the criteria is required between 24 months of the last advance. So for the most part, they're saying if you're using their money, you've got to basically show it on construction within 12 months, or if you're doing purchase plus improvements, then you got to do it within 60 days after they give you the last amount of money. If you're using your own money, which is what we predominantly, then you've got to do it within 24 months of the last advance. This gives you a little bit more cash flow timing, management, just some small items to consider when you are modeling out what your costs are and whether MLI select makes sense. And then unlike the affordability criteria, the energy efficiency or accessibility criteria does not need to be demonstrated on an annual basis. Once it's achieved, the borrower's commitment is considered fulfilled and there are no further requirements. So that's great. You obviously have hit the requirements and you've achieved it. I just wonder if at the end of the term loan, if you decide that you want to take out more capital and you want to requalify under MLI Select, whether you have to re-go through this process. So that's a question for your mortgage broker. All right. So, Mitt, you've been talking about all of this. Like, does this make sense? Like, why would people do this? Well, it's because with the different amount of points, you get different amounts of maximum loan to values and different amount of amortization periods. And you have different types of recourse. So obviously with new construction, there's rental achievement holdbacks that occur. Again, the loan to cost is usually going to be like up to 95% of loan to cost. Loan to value will depend on obviously where your rental numbers will hit. But if you hit minimum 50 points, you get 40 years, 70 points, 45 years, 100 points, 50 years. And again, as we talked about previously, when we look back at the new construction requirements, you can easily make your building accessible when you're building a brand new, so you can easily achieve 20 to 30 points there. You can do anywhere between level, like you can do any of these really when you're building brand new because you're doing it leveraging CMHC's financing, so it's very easily achievable for you to use a combination of energy efficiency with accessibility to get your minimum 70 points to get 45-year amortization with full recourse. If you're trying to cap out how much the government, like basically if you default on it, that they can come back after you for, you will try to hit the minimum 100 points and to get the 50-year amortization. So in order to do that, realistically, you're going to have to do energy efficiency for new construction. You're going to have to do 30 points on accessibility, and you're going to have to probably, well, at that point, you might just say, you know what, I'm going to do lower amount of energy efficiency, and you will just do 10% of the new construction units as affordable. So as you can see, for new construction to get max value, what you're very likely going to do is just do affordability with a minimal amount of energy efficiency and accessibility. And you'll basically cross and hit the requirements that are needed for getting the maximum loan to value, which again is 95% of cost or the loan to value that is determined by CMHC. But again, that's based on the loan to value of the value as determined by CMHC, not by your appraiser. So that's a very important aspect. So really when you're thinking, oh, I'm getting 95% loan to value, you are not getting 95% loan to value. You're probably getting a lot less, and we'll see that in one of our examples that we do in another video. And then how does this apply to existing properties? Again, similar point structure matters, except they're giving you less loan to value. So on existing, they'll go up to 85%. On 70 points is when they'll finally give you 95. Similar discretionary and recourse apply here as well, which is why people might go for 100 points. But as we determine here, even if you were to say redo your building for accessibility, you got 20 points there. And then you're looking at existing. In order for you to get 100 points or get to the 100 points, you're going to have to put a portion of your building into affordability. So if you want to take your existing building and you want to make it affordable to hit 100 points, because again, you're only going to get maximum 70 between going to say the maximum energy efficiency and the maximum level 2 criteria here for accessibility, you will be short 30 points. So what you're going to have to do is either cut energy efficiency out and just do 50% affordability. 50% affordability, or sorry, 60% affordability here, or level 1 affordability with some energy efficiency. So ultimately, like keeping 40% of your units at the median renter income, especially if you're focusing on Toronto GTA growing markets, it doesn't really make sense. Just to give you a real quick reference point, every $100 in value, $100 a month in rent that you're decreasing on a per unit basis, or just for one unit, $100 decrease translates to $25,000 in value that's reduced. So even though you're doing all this work, you might end up being capped because you won't be able to legally allowed to increase your rents. And so longer term, as you continue to increase the value of the building, you have natural turnover from people moving out or transitioning away, you won't be able to boost up your building value and take cash out. So it is very restrictive from that standpoint if you are trying to go for the maximum points under MLI. So really when you're doing existing, so for new construction, totally MLI is like a no-brainer. You could totally make it make sense to get the maximum loan to value and juice out your capital to have the least amount in. For existing, MLI becomes very deterrent just because you are being capped out by the points for having to keep certain units affordable if you're especially trying to make a higher return. So really the maximum you're going to get to is 50% energy efficiency, 50 points on energy efficiency, and 30 points on accessibility, so 80 points in total. So that's the best you'll look to do is probably do 45-year AM up to 85% loan to value. But again, now you have to think about it. You're going to have to do all these energy efficiency items in your project. So realistically, you have to determine whether to make the building accessible and energy efficient. Is it really worth going all the way up this high? Or are you just good with 85% and 40-year amortization with minimum 50 points, which you can just do through energy efficiency and lower energy efficiency and lower accessibility requirement? So obviously we talked about what the loan to value is, the amortization periods and all of that, but a real larger portion of why MLI comes into place is really the debt service coverage ratio. Basically, under CMHC, for standard housing, you will be able to get 1.1. As we saw in the previous video for standard housing, you're looking at 1.2 on anything greater than 10 years or 10 years or greater, and we're looking at 1.3 on 10 years or less. So obviously you're getting a much higher debt coverage ratio by qualifying under MLI, but again, you are having those costs related to energy efficiency that you will have to spend. So that is a factor you need to take into consideration for energy efficiency and accessibility for your existing buildings, and then for new buildings as well. This will come into place. Here, CMHC says they'll give you a 95% loan to cost on new construction and 75% on the non-res component. Existing buildings, they will do 95 loan to value on the residential component and 75 loan to value on the non-res component. Again, this ties back to make sure you hit the criteria. So as we said, likely under MLI for existing buildings, if you're looking to obviously maximize profit, you're really only going to probably hit like 85% to 90% loan to value as determined by CMHC. So again, I really emphasize that a lot in this video and this video series, is because when we go look at bank versus CMHC standard versus CMHC MLI select, there is quite a variance. And again, similar to the standard program, you know, your fixed amortization, you have a fixed interest rate or floating with the ceiling rate. CMHC will go up to 50 years here versus it's less for standard. Again, similar type of mortgages allowed. You need to get obviously approval for second mortgages, but you can do pari passu second mortgages through CMHC afterwards. And under replacement reserves, depending on if it's a brand new build and stuff like that, CMHC might make some more adjustments. So that's one of those things there. And then just again, similar general items that come up here is you need to have 25% of the loan amount being required. Obviously, if you score over 100 points, they will be more flexible. So what that means is, obviously, if you solve their program or the government's issue of providing more affordable housing by you making a lot less money, then they will tell you that it's okay that you are not worth a lot more money, and it's okay that you don't necessarily meet the borrower net worth requirement under CMHC. But your lender might say, hey, I still want you to hit it. So again, something you have a conversation with your mortgage broker on. And typically, the borrower of a corporation affiliated with the borrower must have at least 5 years of management experience in the operation and management of similar multi-residential unit apartments, or a formal property management contract must be in place with a third-party management firm. Why does this matter? Well, the government doesn't just want to give out insurance and allow people to take advantage of the program if you just signed up as a new real estate investor and you watch a couple of YouTube videos and now you want to leverage your whole life into becoming a multifamily investor. Unfortunately, the government will put limitations, and honestly, if you don't have this much years of experience and you're trying to obviously leverage your capital as much as possible to do larger projects, you probably want a third-party company who has more experience involved to give you some advice. So that's what you can have there. You can also just partner with people who have that experience as well and help you meet that requirement. But it is definitely something lenders will ask you as they're going through due diligence with you. And then obviously there's like the guarantee requirements, as we talked about before. Again, for the most part on takeout financing, after the building has been stabilized for new construction or completion takeout, 40% will still, the CMHC can still go after you for 40% if there's ever a default in a construction area. Same thing happens in regards to a purchase or refinance of an existing building. And then obviously where the loan is, 65% or below, or they can't provide guarantees like not-for-profits or community-based organizations or social mandate-driven borrowers. As long as there's like 100 points achieved, again, you're providing that affordable housing. CMHC might be able to like limit it or waive it. Obviously, they won't do that if there's fraud or environmental liability. And the recourse of the approved lenders shall be limited to the property and other assets taken as security, not personally against the borrower. Again, they're obviously trying to make it so that not-for-profit housing can take advantage of these programs and stuff like that. But as we've all seen in industry practice, they don't really understand the business, and so they end up overpaying third parties. And so, yes, this program helps them with financing, but the private sector should probably solve social housing more so. And anyways, CMHC may require additional risk mitigation, equity retention, replacement reserves, collateral security, personal guarantees. One thing to remember, guys, back in the pandemic, or as the pandemic was starting and rates were really low, people were doing a lot of high equity takeouts. So with CMHC standard program and CMHC MLI select program, they put a limitation that the funds could only be refinanced and reused for properties. It couldn't be used for takeouts by the borrower. So if you're sinking your whole net worth into this kind of stuff, just know that they might not let you take it back out depending on when you finish your project. You're looking to go take out some capital in the future. So always something to consider, which is why you should always be considering multiple financing options, whether it's private lender, bank financing, CMHC standard, or MLI select. You've got to look at them all above. So hopefully you enjoyed this kind of glance at, an overview of the CMHC MLI select program. If you have any comments, questions, or concerns, feel free to drop it in. But these are all things that we're considering every time we're underwriting a deal, whether it's going to go through bank financing, CMHC standard, or MLI select. So thanks for joining, and we'll see you soon.